Whilst on this sort of general topic of commodities and how they perform, how they are not performing, what their performance means to portfolios, if anything, I thought I would take a look at one of the broad measures that is used as a metric to indicate how well commodity markets are perceived to be performing. What has prompted this is this chart appeared in my inbox. It's a chart that looks at the CRB Commodity Index total return going back to the turn of last century. And there's a few dates highlighted on the upside. There is the inevitable reference to the oil crisis in 73, the end of the Second World War, which they've marked as 1946, which is actually 1945, and Roosevelt's New Deal. The CRB index has been used for quite a long time as a metric to show how a broad basket of commodities is performing. Part of the difficulty with this is that when traders look at this, they assume that it is like a stock index. A stock index is very homogeneous. All stocks can be regarded as being the same for the purposes of inclusion in an index. Commodities/futures contracts are very different. And if we have a look at the construction of the CRB index, you can see there's 19 different commodities, and they're all different bibs and bobs, supposedly representing a broad cross-section of common and widely used commodities. But there is a problem when we look at charts like this. And the problem is a simple one. And the problem is that we are not comparing like with like. If you look at the original components of the CRB index, you see a variety of quite quaint historical commodities. Things like cottonseed oil, grease, there's eggs in there, lard, onions, soybean, potatoes, and these are legacy commodities. But they're in no way comparable in performance to the modern day components. So we have this issue of not comparing like with like. So that when we come across something like this, comparing an index to past periods, that comparison is largely irrelevant. You cannot compare the index over deep time like this. Yes, you can make intergenerational comparisons, so that if we were to go back, say, to the year 2000 or the early 1990s, there you could make some form of comparison. And that would be valid because the components of the index would be very similar to the components today. We would not be comparing the index with these very legacy commodities that are a throwback to a different time. It's a little bit like saying you can compare a modern supercar and its performance to that of a Model T Ford. You can't really do any such thing. You can't make any practical judgment based upon the passage of over 100 years, because there's been so much evolutionary and revolutionary change within markets that the comparison falls apart. But the other point here is the title, Chart 8, Commodity Prices Very Overbought. My response to that is overbought, oversold, so what? Unfortunately, this is one of these emotional metrics that traders fall for, in that they believe that if a market is overbought, it must instantly come down. Markets can remain overbought for years. This is simply the function of markets. There's nothing you can do about it. So any judgment as to whether anything is overbought or oversold is really a fairly relative and not absolute judgment. And in no way can you convince a market that it is overbought or oversold. It's impossible to do so. And if we look at the performance of the CRB index, I've got two metrics here. The first tracks its movement from its low in 2020, and the lift from there to current day is about 172%. The lift year to date is just over 25%. That might seem extreme, but again, it has to be viewed in context of the history of price. And when we do that, you can see that the CRB index is quite capable of having extended runs that are very dramatic. That is simply the nature of price. Which brings me to a very, very important point, and it's a point that traders miss. We are paid on price. We are not paid on our analysis, our narrative, our perception of the market, the story we bring to the market. We're not paid on our predictions. You're actually paid on price. So the way the CRB index pays you when you look at something like this is how well you manage to catch those long-term trends. It's not how well you manage to make pronouncements as to whether you consider the market to be overbought or oversold. That's an irrelevancy. That in no way puts money in your bank account. What puts money in your bank account is how well you've managed the trade as it has unfolded. And dare I say it, if you've even managed to get on the trade. Because one of the things I've found about people who use terms like overbought and oversold is that they don't actually do a lot of trading. They do a lot of talking about trading. They do a lot of discussing of indicators with other people who talk a lot about overbought and oversold. But at no point do they ever actually trade. Trading is a somewhat dirty profession that is full of uncertainty and is very opaque. And you are paid for managing that uncertainty and for dealing with the stress that not knowing what tomorrow brings. But when you look at these composite indices, such as the CRB, it does raise the question as to who does the heavy lifting. And when you look at the construction of the index, you can see that they're split into four groups. And initially, at first glance, they look logical. They look as if they make some form of sense. But when you dive a little bit deeper, you begin to notice that there are strange anomalies. For example, if we were to just look at Group 1, you would see that there's a collection of energy-related instruments. That seems logical and fair. But if you look at Group 2, if we were to scan this lightly and not pay particular attention to it, you would go, well, it's got corn, soybeans, live cattle. Therefore, it has something to do with sort of agricultural commodities. But then there's natural gas, gold, aluminium, copper, which bear no relationship whatsoever to corn, soybeans, or live cattle. Group 3 looks homogeneous. It has sugar, cotton, cocoa, coffee. But when we get to Group 5, we've got this odd mixture of metals and some agricultural commodities, which is a very, very strange arrangement. But what is intriguing is where the actual weightings sit. And the highest weighting commodity within this index is crude oil at 23%. You would not be forgiven for making this somewhat rash judgment that the CRB index is actually really in many ways just a proxy for crude oil, and that crude oil is a proxy for the CRB index. And this becomes interesting when we start to break down the returns for each commodity during sort of this first quarter of the year and the contributions that they in turn make to the overall return of the CRB index. And all I've done here is list the commodities as they appear in the index listing. So they're not sorted on any basis other than whether they're groups 1 through 4. And you can see that as a group, the heavy lifting is done by energy for the this particular period in time, they've been the standout. And I did a very, very quick and dirty price correlation between crude oil and the CRB index. And they have a very, very high correlation. 0.7731 is a very, very high correlation to maintain over 30 years. But what's more interesting is when you look at the contribution to the return of the index for this quarter from each of the individual commodities. And the return, or their contribution to the return of the index, is a function of both their individual return and their weighting within the CRB. So if we look across this table here and we look at the first line, which is crude, it had a year-to-date return of 38.82%. Its CRB weighting is 23%. Its contribution in terms of the percentage of the lifting it does for the return in the CRB index to date is 35.7%. If you think of it this way, if you were to drop crude out of the index or assign it a zero return, the CRB index's return year to date would drop by a third. But what is interesting in this is that when you go down the list to group 4 and you see nickel, nickel, because of the short squeeze, has had an extraordinary quarter, up 71.53%. But its weighting in the index is only 1%. So its contribution to the returns of the index is only 2.9%. So it doesn't really matter what sort of year or quarter or half year that commodities like nickel have, they will never make an impact in the CRB index. What makes an impact in the CRB index is crude. Crude is the driver of the index. So what does this mean as to what the index is telling us? Well, the index tends to tell us that crude oil has gone up. But we could work that out simply by looking at a chart of crude. And this comes to the notion of what to trade. Many people trade the CRB index. To be honest, I don't know why. When you can trade the underlying instrument directly, without needing to worry about the handbrake or drag that other commodities might place upon it. So we're back to the utility of things like this. And to be honest, I don't think they have any utility. This doesn't convey anything to me that is worthwhile or useful. It gives me an historical perspective, but the historical perspective is largely irrelevant to what is happening today, because there has been such change in the index as to render all those values in the past obsolete. Yes, they're interesting historical curiosities, but they don't actually mean anything. It's a little bit, and I don't want to stretch the analogy, but it's a little bit like going to the museum and looking at museum pieces. They are very interesting curiosities and they have a very interesting history of their own, and as part of the history of markets, it's very interesting. But the question becomes, what does it mean? And what does it mean to traders? And at the end of the day, I don't think it means anything at all, because the unfortunate universal rules of trading simply boil down to the notion that if it's going up, you buy it, if it's going down, you sell it, and you don't bet the farm. There's no need to be worried about historical curiosities and this notion of whether that historical curiosity or anachronism is overbought or oversold, because we come back to this central point that at the end of the day, you are paid on price, and the price you are paid is a function of your trade management, not your trade analysis, perceptions, understanding of history, or even interest in history. You get paid when you close the trade out.